Imagine an invisible atmospheric pressure crashing through a densely packed city. The buildings hold firm, but the air warps, altering how every structure relates. This chart shows the value of the US dollar against a broad basket of global currencies. In 2022, that line spiked, pushing the dollar to a multi-decade high. In politics and media, we tend to equate a strong currency with national health. But global finance does not operate on national pride. A strengthening currency acts as a financial weapon, quietly rewriting the rules of global survival. Classical economic theory frames currency appreciation as a distinct advantage. A highly valued currency gives a nation purchasing power abroad, making imported goods cheaper and suppressing domestic inflation. But that mechanism creates a penalty for domestic producers. As their local currency rises in value, their exported goods become far too expensive for foreign buyers to afford. Here we see two identical manufactured goods competing on the global market. As one country's currency appreciates, the price tag on its export artificially inflates, pricing it out of contention while its competitor's price remains static. If the classical rules hold true, that a strong currency strangles exports, we have to ask why certain modern economies experience aggressive export growth precisely when their currencies are surging. That contradiction reveals a flaw in the textbook models. The old rules fail to account for the physical mechanics of modern supply chains. To understand the damage a surging currency can inflict, we have to look at the extreme end of the spectrum, known as Dutch disease. It often begins with the discovery of raw natural resources, triggering a sudden influx of foreign wealth that inflates the local currency. As that currency spikes, the country's other sectors face immediate pressure. Local manufacturing collapses because it can no longer compete on price internationally. The nation becomes dependent on its single booming export. The broader industrial base simply erodes away. Economic strength isolated to a single volatile sector actively hollows out the rest of the economy. Former transition economies in the European Union presented a direct challenge to this model. They maintained robust, export-led growth despite significant appreciation in their domestic exchange rates. The explanation lies in global value chains. Modern industries rarely build a product entirely from scratch within their own borders. They must first import raw materials and intermediate components in order to export a finished good. This exploded view shows a smartphone with components sourced globally. As the domestic currency strengthens, the cost to import these individual parts drops. Those savings on imported materials offset the exchange rate penalty applied to the finished product. The final export price holds steady. Highly integrated environments, like modern auto assembly lines, rely on thousands of cross-border transactions. They are structurally shielded from these currency shocks. In a globalized world, a strong currency acts as a hidden cost-saving mechanism for nations embedded in global supply chains. But that protective effect vanishes when we examine the US dollar and dominant currency pricing. The vast majority of global trade is invoiced in dollars. This holds true even when the United States is entirely absent from the transaction. When the dollar strengthens, emerging markets face a sudden crisis. They are suddenly forced to pay much more in their local currencies for essential, dollar-priced imports like energy and food. Developing nations are caught in an economic vice, crushed between the rising cost of basic survival and the mounting expense of servicing their dollar-denominated debts. A surging US dollar operates as a heavy, involuntary tax against the world's most vulnerable economies. This dominant currency effect creates an optical illusion in global trade data. This chart shows an emerging market's imports seemingly collapsing in dollar value. But when we measure the actual physical volume of goods arriving at the ports, the levels remain stable. Analysts relying strictly on dollar value metrics will misdiagnose a collapse in demand. In reality, it is simply currency math obscuring a stable physical trade flow. A strengthening currency is a macroeconomic shock that reorganizes global winners and losers. It rewards nations deeply integrated into complex supply chains and punishes those reliant on raw exports or carrying foreign debt. Global capital and trade are forced to alter their course, reacting to pressures that exist entirely on paper. Ultimately, currency fluctuations act as invisible levers, dictating the survival of industries and the wealth of nations.